Well, thanks a lot for that. First, let's look at the stock performance. In the past 6 months, the Reliance stock is up almost about 15% at 31.50. Currently, it's had a strong run in the past 6 months. Let's take a look at the numbers as well. On the revenue front, year on year, we're expecting an improvement to 2.3 lakh crores versus 2.07 lakh crores same time last year. The EBITDA is expected to rise to 39,845 crores versus 38,100 crores same time last year. And the profits are expected to rise to 18,432 crores versus 16,000 crores same time last year. Now, what can you expect this time around? The consolidated EBITDA will see a marginal growth year on year. However, sequentially, we are expecting a weaker growth on the back of lower gross refining margins and muted growth in the Jio and retail business. Jio is expected to see stable average revenue per users and 9.3 million overall net additions versus 11 million quarter on quarter. Even the average revenue per user is seen flattish at 182 versus 181.7 last quarter. Now, we can expect a modest 2% quarter-on-quarter EBITDA growth on increased store footprint and operating leverage in the retail business. So, yes, it will be quiet in terms of a sequential performance for the retail and telecom business, but on a year-on-year basis, we are expecting a decent improvement.
So expect a steady quarter from Reliance Jio this time, a 2.9% revenue growth, which will be driven largely by volume growth, that's subscriber addition, while the pricing or the ARPU increase is expected to be 0.1 to 0.2%. These are the numbers: 26,712 crore by way of a top line, EBITDA margin seen at 52.5%, while the profit number is around 5,430 according to our poll. Two key metrics to track. One, subscriber addition. How many subscribers come on Reliance Jio quarterly? Expect a number between 9 to 10 million, while ARPU, the average revenue per user, has been flat for the last 3 quarters. This quarter, expect a minor tick up to 182. But Morgan Stanley says that the Q1 numbers assume less importance because the price hike benefit comes in only in Q2 and Q3. According to them, the benefit to the ARPU could be as high as 16 to 18%. But watch out for the net impact because there is downtraining, there is subscriber churn which takes place. So keep your eye on the net impact of the price hike which we've seen very recently.
Well, let's talk about the O2C and oil and gas business in terms of preview. Let's start with O2C. Now remember, last quarter was very strong in terms of the O2C margins, but this time around, Singapore margins, they have fallen on a quarter-on-quarter basis on weaker cracks for key products. For instance, something like a diesel crack, it has fallen to $14 per barrel versus $21 per barrel. Even kerosene and ATF cracks, they've fallen to $13.5 per barrel versus $20.8 per barrel. And weaker GRMs on a quarter-on-quarter basis will lead to lower O2C margins this time around. The petchem margins, however, will be resilient. In fact, there is modest improvement which is expected as well. But overall, if we go by the EBITDA expectations, these are put up by Kotak. It is expected to decline 12% on a YOY basis and 20% on a sequential basis. If we talk about the refining margins, though the company doesn't report it, it is seen to decline at 18% on a YOY basis and 26% on a sequential basis. Now let's talk about the oil and gas business. This has been continuously doing well. This time around, there will be a decline in EBIT marginally because of lower realizations and lower production as well. So overall, EBITDA is expected to increase by 35% on a YOY basis, a mild decline on a sequential basis. Volumes will be up 43% on a YOY basis. They will decline by 2% on a sequential basis. Gas prices, they have declined generally. So it's a decline of 3% on a YOY basis, absolutely flat on a sequential basis. So decent numbers coming in from the oil and gas business.
Reliance Retail, the growth driver of the business, likely to drive growth this time around as well. But the only important thing to watch out for would be the impact of the general elections and the massive heat wave on consumer sentiment itself. But nevertheless, because the company has been expanding its store footprint and footfalls are increasing, that would aid growth, and the EBITDA margin would be impacted positively by operating leverage itself. So year on year, Kotak estimates a near 11% growth in the top line of the retail business, around 77,700 crores in terms of this quarter's revenue, and the EBITDA grows a shade higher at around 11.5%. The number you're looking at is close to 5,750 crores. What it means is that the margins would show a slight improvement closer to 7.5%. But remember, this is the first quarter of FY25. FY24 was a record-breaking year as well, where the retail business revenue crossed 3 lakh crore, the profits crossed about 10,000 crores, and the overall retail store footprint also moved near 80 million square feet. Importantly, the company launched a couple of new formats as well. They are among the top 25 retailers of the world. And remember, their stated policy is to be among the top 10 retailers of the world as well. So how do these new formats, the likes of Tira, Yousta and Swadesh, pan out in FY25 is something that we'll be watching out for. And more importantly, the most important trigger of demerging or value unlocking in the retail business by separate listing is something that would move the stock too.
For more news and updates, all you need to do is follow CNBC-TV18 on all of our digital platforms.